Good afternoon and good morning to all of you joining us here today. We have the pleasure of having Scorpio Tankers presenting here with us. And with us we have Robert Bugbee, President and Director, Chris Avella, CFO, and James Doyle, Head of Corporate Development and Investor Relations. I am Christopher Barth Skeie, Equity Research here at Arctic Securities, and I will moderate today's session. We will start off today's session with a company presentation of their freshest Q1 results before we open up for a Q&A. So if you have any questions, please type them into the chat function. And with that, I'll leave the word and floor to the Scorpio team. Please go ahead.
Thank you, Christopher. If we could please go to slide 5 in the quarterly highlights. In case you missed our earnings, we reported last Thursday. We reported adjusted EBITDA of 293 million, adjusted net income of close to 207, and diluted earnings per share of around $4. We have seen an extremely strong product tanker rate market for the last several quarters, and this continues today. To the top right, you can see the rates we booked in the quarter compared to last year, as well as the guidance for what we've booked so far in the second quarter of this year. The LR2 is close to $52,000 a day, the MR is $38,000, and the Handymax is $25,000 a day. We had a quarter with significant debt repayment and lowering our cash break even, which Chris will talk about later in the presentation. And we maintained our quarterly dividend of 40 cents per share. And we've also been in the process of selling some assets at what we believe to be fantastic prices. If we could please go to now slide 7. I'll do an overview of the market and then pass to Chris. Never have there been so many factors driving our business. Individually, these factors are positive, but collectively they're unprecedented. We've seen increasing global demand, low inventories, and shifts in refinery capacity that have increased seaborne exports in ton miles. At the same time, the fleet has become bifurcated due to Russia, and supply growth has been limited. And the result, as you can see in this graph, is that product tanker rates have remained at high levels over the last 2 years. Today, spot rates for MRs are about $40,000 per day and $58,000 per day for LR2s. And while the LR2s have captured headlines because of their higher volatility and impact from disruptions in the Red Sea, MR rates have shown remarkable consistency and served as a clear indicator of the robust underlying demand for refined products. And this continues today. Next slide, please. As you can see here, refined product demand has been extremely strong. We're above pre-COVID levels, and we expect further increases this year. Actually, 1.5 million barrels a day more year over year, driven by increases in consumption of diesel, gasoline, jet fuel, and naphtha. And as global demand has increased, so have seaborne exports. Next slide, please. So what you can see here is the March exports over the last few years. And as a result of this increase in demand, we've reached record levels of seaborne exports, particularly in March, at 21.1 million barrels a day. And this is an increase of 1.1 million barrels per day above pre-COVID levels compared to 2019, and 500,000 year over year. So we're still seeing increases in seaborne exports as global demand grows. A lot of the growth has been for diesel, gasoline, and jet fuel. We've actually seen naphtha a little bit more flatlined, and we think that's an exciting catalyst along with jet fuel as we go through this year. And moreover, not only have exports grown, but the distances the barrels are going has significantly increased, a concept called ton-mile demand. Next slide, please. A lot of this has to do with where the refineries are positioned and where the consumer is. There's been a lot of closures of capacity in Europe, the US, Australasia, where local output has been reduced and increasing the need for imports. And at the same time, new capacity places like the Middle East, has increased production for export purposes. So basically, the Middle East, these export-oriented refineries are filling that gap as these older, less efficient refineries close. And what this has done is extend the distance that these barrels need to travel, and that has tightened supply, because as vessel capacity is reduced, supply tightens. And these refinery capacity changes have been going on for a while, really over the last, say, 5 to 10 years, but we're really benefiting from them now, specifically a lot of these closures. Next slide, please. And so ton mile demand has increased about 21% since 2019. And that's excluding Russia. So if we want to look and factor in Russia, that would be an additional 6%. So I think it's easy to look at the markets today and say, you know, a lot of the increases we've seen have been a result of Russia, but it's really in part due to these refining capacity changes. That said, geopolitical events have had a bit of impact on our market, and it leads to a less efficient fleet that must go a longer distance. For example, attacks in the Red Sea have reduced product tanker volumes in the Suez Canal by 75%, a pretty significant amount, and increased the volumes going around the Cape of Good Hope by 400%. On average, you know, these voyages are about 50% longer to go around the Cape of Good Hope, and that's had a big impact on the LR2s. So what we've seen is essentially geopolitical events have exacerbated strong supply-demand fundamentals. Next slide, please. Obviously, with strong spot and time charter rates, coupled with an aging fleet, we've seen an increase in new building orders. Currently, the order book set to deliver over the next 3 years is around 14.8% of the fleet. Meanwhile, the fleet continues to age, and with the average age of the product tanker fleet now being 13 years old, that's significant. You can see that in the graph on the left. And so what does the fleet really look like by 2026, when, you know, a portion of these vessels will have delivered? Well, by then, about 50% of the fleet will be older than 15 years, and 21% will be 20 years and older, positioning themselves as potential candidates for scrapping. So using a conservative scrapping assumption, fleet growth looks modest over the next 3 years, which is fantastic for us. Next slide, please. And then just focusing on this year's fleet growth, it's expected to be about 1.4%, quite low, with seaborne exports and ton miles expected to grow 2.6 and 7%. So we're very constructive on the supply-demand balance looking forward. And I think the confluence of factors today in our market are constructive individually. We've got low inventories, increasing demand, exports and ton miles. We've got structural dislocations in the refinery system, rerouting of global product flows, and limited fleet growth. So combining these all together collectively, it's unprecedented, and it's a really exciting market. And with that, I'll pass it over to Chris to go through the financial slides.
Thank you, James. Good morning, good afternoon, everyone. If you can go to slide 15, please. Next slide, thank you. Okay, the first quarter combined another strong seasonal quarter with the dramatic expansion of ton mile demand triggered by the events in the Red Sea. As you can see on the chart on the upper right, we've generated over $1.3 billion in adjusted EBITDA over the last 5 quarters and $777 million in adjusted net income. This has enabled us to increase our dividend. We paid $80 million in dividend over that period of time, but more importantly, we've been able to buy back $490 million worth of stock in the open market. And I'll emphasize that those purchases have been at about $50 per share on average, so significantly less than today's current market price. Next slide, please. Deleveraging has been our primary focus, and as we announced last week, we reached our net debt targets. As the charts on this slide illustrate, our gross outstanding debt at December 31st, 2021 was $3.2 billion. As of today, this stands at $1.4 billion. More importantly, this chart also highlights the shift in the mix and composition of our debt, away from expensive lease financing and into more traditional bank financing, which has lower costs and greater flexibility. Looking back, $1.7 billion of our outstanding debt at December 31st, 2022 was lease financing obligations with margins of over 350 basis points. Today, our lease financing obligations stand at just $183 million. We've committed to repurchasing 4 more lease vessels in June for $102 million. That once complete, these repurchases will bring our lease obligations to just $81 million and just 3 vessels. It's important to note that our traditional bank loans have margins of less than 200 basis points. So we've carved off over 150 basis points on average from our cost of debt. We can go to the next slide, please. Slide 17. Thank you. As we announced last Thursday, we're currently in discussions with the lenders on our $1 billion credit facility to make a prepayment of up to $223 million on the term portion of this loan. This amount represents up to 2 years of loan amortization, which is for the period commencing in the third quarter of 2024 through the second quarter of 2026. It's important to note that this payment is still subject to lender credit committee approval and the execution of definitive documentation. If approved, repayments would not be scheduled to resume again until September of 2026. We're taking this step in an effort to effect a significant and immediate reduction in our cash break-even costs. We project that the company's daily cash break-even costs, which include vessel operating costs, cash G&A, interest payments, and regularly scheduled loan amortization, will come down to about $12,500 per day after giving effect to this prepayment. By pursuing a long-term reduction in our cash break-even rates, we're positioning the company to opportunistically increase shareholder returns. If we step back to 2021 and early 2022, our break-even rates were approaching $18,000 a day. Since then, we've entered a period of high inflation when there has been upward constant pressure on the company's costs, and benchmark interest rates have increased from just 25 basis points to well over 500 basis points where they stand today. This is why we continue to focus on debt reduction as a tool to combat cost inflation. Our recent efforts to reduce debt have laid a solid foundation for potential greater capital returns going forward, regardless of the strength of the future market. Next slide, please. Our second quarter of 2024 coverage across the fleet, including time charters, is averaging close to $38,600 per day. These rates illustrate the company's operating leverage. At $30,000 per day, the company can generate $547 million of cash flow per year, and at $40,000 per day, $937 million. It is important to note that these cash flow metrics do not take into account the potential impact of the prepayment on our $1 billion credit facility. I'll stop there, and I think that concludes our presentation, so we could probably turn it over to Q&A.
Great, thanks. As a reminder, please insert your questions in the chat function, and I will take them as we go. I have one question to start with. It's with regards to capital allocation. So, I mean, the most discussed and hot topic concerning Sting has been capital allocation and what to do when and expect when the net debt level is reached. So what's next is the question.
I think that what's next, I think we were pretty clear in our conference call that you know, our preference is whilst you have a discount to NAV would be to acquire stock as opposed to raising dividends.
And how do you see that going forward, Robert? I mean, the companies that are paying out 100% out of EPS have gotten a premium in the equity capital markets, while you have sort of previously stated that that's a too high payout ratio for a cyclical industry. Has that changed, sort of, or how do you see that? Once you reach sort of NAV pricing?
It doesn't matter where we will reach. We won't be doing these high payout dividends. History is not on the side of those things.
No. And next question. With the cash break even of $12,500 per day, what can we expect in terms of chartering strategy? Are you considering doing more term business, or sort of, given that you have done a fantastic job in terms of deleveraging, are you willing to sort of give away optionality, or just stick to the spot market with the vessels that are still not chartered out long term?
Yeah, we're very confident of the spot market as it sort of exists. In fact, that we argued very clearly on the conference call that we actually think it's even going to go higher. We're in a very strong period now as we're moving into driving season. We're moving past refinery turnarounds, etc. I think that we will continue the chartering strategy we have, which is that we will, with certain customers, certain strategic partner customers, we're always happy to look at putting a vessel out on time charter. I think that what the 12,500 is just makes any of the returns at any market, whether it's on time charter or on spot, much better. And I think that I think that there's no reason at the moment for us to change what we're doing. And we have some time charters that are coming off time charter. So overall, you may see some. It's likely that you see some time charter activity over the coming weeks, months, but it's not a change of our strategy. We're still fundamentally believe in the returns in the spot market.
Are you seeing? Yeah.
I would just say if for those that don't know where the time charter market is, it might be helpful to just highlight, that the 3-year LR2 rate is probably around $42,000 a day, and the 3-year MR rate is around $28,000 per day. So these are fantastic numbers. So just to put that into perspective, for those that don't look at the daily or weekly time charter rates.
And is that for a conventional vessel, so that you add eco and scrubber, or just to clarify?
Yes, that's for eco scrubber. So you would be looking at maybe 1,000 or a couple thousand less for just an eco or modern vessel, but still fantastic
for sure.
rates. I think the 1-year LR2 rate's above 50,000, which I think is fantastic because it highlights the forward curve that our customers think is achievable.
Yeah.
Right.
But are you seeing that charterers are getting more and more stressed now? I mean, rates have been fantastic year to date, and there's no signs.
I think there's no question that the interest in the time charter market is very strong and has increased. But you would expect that. I mean, the market, as well as in many ways, the charter market and the stock market have sort of been the same, and they've been quite in denial, quite concerned as to whether the market would really follow through, whether demand would really be there. I mean, it was only months ago that people were talking about recession in the world, weaker oil price going to 50. And what you've seen in these last weeks is, when you're finally seeing it now in the stock prices, is a reversal of that trend. We're seeing a bid under the energy tape in general. We're seeing more robust GDP numbers across the world. So this is what's driving the will to go forward. And even if we take a subject such as the potential reopening of the Red Sea, wherever that might happen, and it certainly doesn't look as if it's going to happen anytime soon, people are realizing that that's not a calamity for the product market. If we look at the world in 2003, where obviously the Red Sea and the Suez Canal were open the entire time, we've more or less seen the same earnings in MRs through those different places. And in LR2s, the benefit may be somewhere between 5,000 and 10,000 a day, depending on the quarter. But even if you knocked off 5,000 to 10,000 a day off the LR2 market, that's giving a very high market, and is certainly, the spot market would still be higher than the 3-year forward time charter implied. So you've got a very much has changed in these last weeks in the space itself, I think.
Yeah, for sure. And the next question is regarding yard capacity. Any views on yard capacity? Most of us state that we are sold out, but some say we are seeing some new yards popping up. Any significant changes on the view from your side?
We will see, the economic argument would suggest that you would see more capacity on the margin going forward from the yards. I think, though, that you've got to put that in an environment that in general you've got, strength across the board, whether it for the future, whether it's in, crude market, etc., or dry. But I think that you've got to look at numbers of vessels on order in relation to the time. So it's not just important to know what the percentage is, it's how long that percentage is stretched over, which is quite a way now, because yards are booked out quite a long time into the future. And you've obviously got to, as we've got in our presentations, etc., many others have too, have got to look at it in relation to, if you want the real acid test, the product tanker is becoming 20 years old. That's crazy. I think a mistake people are making is looking at the products and when you look at LR2s, because LR2s and Aframaxes should really be, entwined and looked at together. They have become fairly, interchangeable of late. So I wouldn't just say that just because an LR2 is ordered as an LR2, it's rather like the present fleet itself. It's a combination of. So in that sense, we're not at this point concerned about the yard order book, but I think that we should all expect that available yard capacity in total across shipping is going to rise as prices have risen.
Great. The next question here is regarding divestment. You mentioned you are selling older vessels for firm prices. Do you have any plans for fleet renewal, either acquiring younger vessels or new builds, or is buying back stock preferred method of capital allocation? I think you have answered that before, Robert, but
yeah, I think that a new building is particularly challenging at the moment in terms of efficient returns on capital, not the least of which because it's not being delivered for a long time. So because yards have got a strong hand at the moment, they're able to command much more front up repayments, and if you're paying for equity out for 2.5 years or so without any return, that's quite a true cost on a market at the moment. If whatever sort of, you have to put, anyone sensible should put at least a double digit 15-17% return on that equity, and that's a lot to put down. So the delivered price of a new building is quite high. and the cost in terms of your equity outflow is quite high. So it's by itself, even if you're looking at comparing it to buying back stock, it's quite high. You would still, on a math basis, prefer to acquire a vessel in the water if you needed to renew your fleet. We of course don't, so we're not, we haven't shown any interest to either order vessels or acquire vessels.
And if you were to go to the yard, I'm not saying that you are, but your competitors are obviously ordering. What type of payment terms are you getting now?
What do you think, James? 10, 10, 10. I mean, 10, 10, 10, 10 60s would be for 4 tons, and the
standard.
60, I guess, would be standard.
Yep.
Yeah, but I think one thing is the generic LR2 new build price today is around 75 million, right? That's not dual fuel. That's probably 27 delivery. It's substantially high. So I do agree with Robert's point that, yeah, there are some new yards popping up, but I think the high prices are a reflection that shipyard capacity as a whole is substantially lower than 2015. It's substantially lower than 2008, right? So you wouldn't have these prices continue to go up as they have, right, if there wasn't some constraint there.
Yeah, for sure. As a reminder, if you have any questions, then please type them into the chat box, and we will take them. So let me see if I have anyone else here. There are no further questions.
I would say, if I might say, I would think that the three things that I think that would stand out to me if we were to all look ourselves in the mirror when it comes to Sting's recent earnings release was first the fairly outstanding beat in sort of showing the profitability of the company, really, when estimates have been sort of in total marked up throughout the quarter on a surprising quarter. The second aspect was, even I was pretty damn surprised that the operating break-even costs were flying down and coming into that 12.5 region, and there's no reason to think that that you're completely done there. And then the third thing is, we weren't expecting. We're super bulls. We're the uber bulls when it comes to the spot market. We keep a very, very high spot market profile, and we've often been accused of being too bullish. But we were surprised how strong this market has been moving and how quick. We expected it to strengthen, but we didn't expect in this last few days to show the signs of what is happening now moving forward. So I think we ourselves have been, where we started in this conversation, have been, pleasantly surprised at this sort of change in the overall sentiment related to, energy and derivatives coming to the product market, and how tight that market really is.
Fantastic closing. Or let me see if I got one more question. Okay, how do you think things will develop if Trump gets or wins the election and stops the Ukraine conflict?
And stops the Ukraine conflict. Well, that's assuming that he will actually want to. I think it'll be unpredictable. There's no guarantee that he will stop the Ukraine conflict. I think that we showed the last time there are differences in between what he will say to secure his base and secure the presidency than what he will do. And very often there is a difference anyway in US presidential elections between what the candidates sort of rallying cry is to get votes and what they're actually able to enable or want to enable at the end. So I think that I don't think that I think we have a long way to go on that one too. You're trying to get predictability from both Trump and Putin.
Yeah.
So we're not going to speculate on that one.
No.
And even if the conflict ends, that doesn't necessarily mean the sanctions on Russian exports end as well. So
No, for sure.
I mean, it's been pretty beneficial to Trump's base, the actual sanctions, right? You've got, anybody with his oil people, his coal voters, his gas voters, that they've been doing pretty well, selling arms at the same time. I mean, it's not a foregone conclusion, as Chris says, that suddenly everything goes back to where it was before.
No, I agree, and to assume that the Western world will immediately stop or sort of stop the sanction seems a bit naive, at least at current time being.
Well, also the customers might view those vessels that served Russia, right, or just haven't been properly maintained. I mean, these vessels on average are about 14 or 15 years old for our segments, at least those MRs that moved over into that trade. So personally, I still think, if it's a year or another year from now, those vessels are going to have a very tough time from a technical perspective, from a commercial perspective, fixing the oil majors, the refiners, given the age and trading history of the vessel as well. So there's about 400 ships that have moved into that trade. And if you look at the MRs, it's over 200. I think it's like 275 ships. So it's a lot.
And sort of, they obviously can't go back into non-sanctioned trade, and sort of how's
Some can.
They
Some
can.
can.
Okay.
Well, it depends. If you followed the price documentation,
Yeah,
the price cap,
sure.
right, and you have that documentation, and certain people have, right? So there might be a reluctance from a customer to take that vessel, but if you haven't, and a fair bit haven't, given the age, these vessels are going to be difficult to come back. So let's just say it's 100 MRs that kind of are staying in that fleet. You're looking at about 8% reduction in the MR fleet per minute. So I think there's going to be these long-lasting impacts as a result of this as well.
And with regards to the Red Sea, there's a new question. How's the situation in the Red Sea developing? Have we seen the full effect of this conflict, or is there more upside in rates?
Well, you're mixing two things here. You're going to see the upside in rates because the general demand for shipment of products, regardless of the Red Sea, is increasing, and we expect to increase over the next weeks. I think that I don't think any of our real peer group is traveling through the Red Sea at the moment. So that's sort of where that is. And I think again, the market's underestimated that it's been market has sort of bet on recession in oil, bet on lack of demand on oil, and is continuing to bet that every time they sit down for peace treaties that they're going to come out and hold hands and everything's going to be fine and the Red Sea will be open the next day. But we have data points throughout this now that are just getting worse and worse and worse and worse. And we also now have data points that the Houthi rebels are, that's kind of getting more and more independent and dislocating from, you're getting a dislocation from the thought that, okay, even if you had peace in Gaza, the Houthis would immediately stop. They've never had more attention and more increases in membership ever. So I haven't seen a rational argument yet as to why that's going to stop again anytime soon.
I think there's a scenario where we haven't seen the peak of the rates though, as well. I think you've had competition from LPG on naphtha, and that has kept naphtha volumes more contained. So if you were to see naphtha volumes come back and more vessels going east, the need for those vessels to go around the Cape of Good Hope west would substantially tighten the fleet. So I think there's an upside case as well.
What's the swing effect on naphtha trade?
It's pricing. A lot of the cheap LPG coming from the US, it's an arb-driven business, and there's a lot of petrochemical capacity in Asia that can switch based on price.
Yeah.
And so if you get a change there, we don't need that to happen, but there's, a possibility.
I would agree with that. And the other parts of it is that just look at the last 4 or 5 weeks of weather, right? We've had some really weird weather. We've had, flooding in South America. We've had kind of hopeless weather in America. It's neither been, hot enough for cooling energy required or cold enough for heating. And, that's changing. We're going to get into the heating season too soon. And we're going to get into the travel and the holiday season too. So now the possibility of what James is saying, I think, is there. I just, for me, I don't think you have to plan for that. I think you can safely plan for increased rates. You don't, and if you get the cherry on top of the icing on top of the cake with, rates that are higher than we've seen before, great.
Yeah, for sure. I mean, it's about getting.
But you don't need to invest off that basis.
Yeah.
No, I mean, it's you're earning run rate EPS of $20 an annum now, so you don't need a lot of rate improvement to find the thing interesting. Great. I think that concludes it from this session. Thanks a lot to the Scorpio team with Robert, Chris, and James for joining us here today. And if you could not attend the full session, please reach out and we'll get you a replay. So thanks all for joining, and please reach out should you have any questions. Thank you.
Thank you so much.
Thank you.
Thank you.